I'm Jono. Affirm versus Clearpay. Let's see what the real cost looks like.
Two buy, now pay later platforms at opposite ends of the product spectrum. One offers monthly installments at annual percentage rates up to 36%, reports every loan to credit bureaus, and produces credit file consequences that persist for 7 years after a default. The other offers 4 interest-free payments over 6 weeks, a soft credit check, and an account freeze loop that its own support team cannot resolve. Affirm and Clearpay. Affirm's horror story is 2 paid collections under $100 each, both still on the credit file, disputes rejected, 7 years on the record. Clearpay's horror story is identity documents submitted 6 times, 1 confirmation email, and the account still frozen. One punishes like a loan because it is one, the other punishes through operational failure. On a product that carries no interest at all. 2 products wearing the same category label with almost nothing else in common between them. Affirm is an installment lending platform built by the co-founder of one of the first major internet payment companies. Max Levchin founded it in 2012 in San Francisco with a thesis that the credit card industry obscures the true cost of borrowing and that consumers deserve to see the total cost of a loan before they commit. The product range includes interest-free 4-payment splits, similar to the other platforms in this comparison, but the distinctive offering is monthly installments over 3 to 36 months at annual percentage rates from 0 to 36%. No late fees, fixed terms, fixed payments, disclosed rates. The company went public on the technology exchange in January 2021. Full year 2025 revenue reached approximately $3.22 billion. Partnerships with the largest online retailer, a major commerce platform provider, and a major mobile payment service extended the product into everyday retail. However, the credit reporting reality is the most financially serious consequence in this comparison. Once a loan is originated, it is reported to credit bureaus as a financial obligation. If the loan goes to collections and is subsequently paid, the paid collection record remains on file for 7 years. 2 accounts under $100 each, paid in full, disputes rejected, 7 years of credit file damage. The consumer who encountered the product as a simple way to split a purchase discovers that a sub-$100 default creates a credit consequence that outlasts any other penalty documented in this comparison. A mattress return where the refund came back $500 short of the purchase price, with the merchant and the lender each pointing at the other, demonstrates the structural difficulty of returns in installment lending. Clearpay is the United Kingdom brand of the Australian platform that was acquired for approximately $29 billion. It launched in the United Kingdom in 2019 and reached 1 million customers by 2020. The product does one thing: 4 payments over 6 weeks with no interest if paid on time, no financing product at variable rates, no monthly installment option stretching to 36 months. The simplicity is deliberate. Bounded late fees, a soft credit check, dynamic spending limits visible in the application. The legal entity is separately registered with the Financial Conduct Authority, but the complaint record centers on operational failures rather than credit consequences. The identity verification freeze loop, where documents are submitted, a confirmation email arrives, and the account remains frozen, is the defining pattern. A user submitted documents 6 times across months without resolution. A long-standing customer with years of on-time history was suddenly frozen without explanation. A user was charged £119 for a cancelled order and could not get a refund without escalating to the government's trading standards body. And the United Kingdom mortgage warning adds a dimension that does not exist for the other platform in this comparison. Buy now, pay later. Activity on bank statements can affect mortgage affordability assessments. Mortgage advisors warn against using any product in this category in the months before an application. The potential downside of losing a mortgage offer is disproportionate to the convenience of 6 weeks of deferred payment. The regulation taking effect on July 15, 2026, will introduce affordability checks matching the standard applied to credit cards, formal authorization requirements, and complaint rights through the Financial Ombudsman Service. The direct comparison reveals 2 products that share a category label and almost nothing else. Affirm is a credit product. It issues loans, reports them to credit bureaus, charges interest at rates up to 36% on longer terms, and produces credit file consequences that persist for 7 years when things go wrong. The transparency is real. The rates are disclosed, the terms are fixed, but the consequences are the consequences of a loan, not of a payment split. Clearpay is a payment split. 4 interest-free payments over 6 weeks. No variable rates, no monthly installment product, no credit bureau reporting on standard accounts until the regulatory landscape evolved. The consequences when things go wrong are operational, frozen accounts that support cannot unfreeze, charges for cancelled orders that require formal escalation, and a mortgage risk that exists because of the United Kingdom's specific affordability assessment process. The regulatory context is different in each market. Affirm operates primarily in the United States, where the consumer financial protection regulators attempt to classify buy now, pay later under existing credit regulations was described in a February 2026 law review analysis as a failed attempt. Clearpay operates in the United Kingdom, where the Financial Conduct Authority has confirmed formal protections effective July 2026. The same category of product, regulated at different levels of rigor, depending on which side of the Atlantic the consumer lives on. For a consumer choosing between the two, the question is not which product is better. It is what kind of risk they are choosing. Affirm's risk is credit file damage that can persist for years and affect future borrowing for mortgages, car loans, and other significant financial commitments. Clearpay's risk is operational friction and a mortgage-specific vulnerability that exists because of how United Kingdom lenders assess affordability. If you are financing a large planned purchase and understand that you are taking a loan with a disclosed interest rate that will be reported to credit bureaus, Affirm is the most transparent installment lending product in this comparison. No late fees, fixed terms, fixed payments. The rate is disclosed before you commit. Accept that the credit file consequences when things go wrong are the most severe in this comparison. A paid collection remains on your record for 7 years. A return dispute can leave you hundreds short with the merchant and the lender, each pointing at the other. Do not stack multiple installment loans across different merchants. Each one is a separate financial obligation, visible to future lenders. If you want to split a planned purchase into 4 interest-free payments over 6 weeks in the United Kingdom, Clearpay is the simplest product available. Accept that the account freeze loop can persist for months without resolution, that support may confirm a fix that has not actually been applied, and that a charge for a cancelled order may require formal escalation to resolve. If you are anywhere near a mortgage application, do not use this product or any product in this category. The regulation taking effect in July 2026 will introduce affordability checks before approval, which means the responsibility for assessing whether you can afford the payment will shift from you to the provider. The category label says buy now, pay later for both products. One is a loan with a 36% ceiling and 7 years of credit file consequences. The other is an interest-free 6-week payment split with an account freeze loop and a mortgage warning. They are not the same product. They are not the same risk. They are not even the same kind of financial commitment. The only thing they share is a label, and that label tells you less about what you are agreeing to than almost any other detail in the terms. The regulation arriving in the United Kingdom acknowledges this. The regulation that failed in the United States does not. And until both markets treat these products with the same scrutiny applied to credit cards, the responsibility for understanding what you are signing up for remains with you.